Most people believe their money is sitting quietly in a bank vault, tagged with their name, waiting patiently for the day they decide to use it. It's a comforting picture, a neat safe box in some climate-controlled room, untouched, unbothered, and perfectly preserved. But that's not reality. You see, the moment you deposit your money, it stops being yours in any practical sense. Legally, it becomes the bank's asset and your liability, a number on a ledger promising they owe you something back someday. In the meantime, they use it as raw fuel. It becomes capital for them to lend, trade, speculate, and move across the world at blinding speed. And move it they do. They push it into bond markets, they make leveraged bets on foreign currencies, they park billions in short-term debt one day, then swing into derivatives the next. They trade interest rate swaps, credit default swaps, options, and futures, contracts most depositors couldn't even describe. They even take concentrated positions that, if they go wrong, can detonate in spectacular fashion. These are not careful, conservative moves designed to protect your money. They are aggressive, calculated risks, the kind that would make most individual traders' palms sweat, and they do it with other people's capital. They do it with your capital. Here's the insult. You get none of the upside. They might toss you a fraction of a percent in annual interest, and numbers so microscopic it's barely visible without a magnifying glass, while their traders make double-digit returns on the same pool of money. That spread isn't just their profit, it's your opportunity handed over for free. If you think these risks are theoretical, if you think banks play it safe, history says otherwise. The names and dates change, but the pattern stays the same. In 2025, Bruno Ixel, nicknamed the London Whale, was a trader in JP Morgan's chief investment office who quietly built massive synthetic credit derivative positions, bets so large they started distorting the very markets they traded in. The capital, ultimately traceable back to customer deposits and bank reserves. When the trades went sour, the losses topped $6 billion in a matter of months. Depositors received the same meager interest as before, while the bank's traders, remarkably, still collected bonuses. In 2008, Societe Generale's Jerome Kerviel, working in Paris at one of Europe's largest banks, managed to amass a $50 billion unauthorized position. These weren't small side bets, they were massive directional wagers on European equity futures. When they imploded, the bank lost 4.9 billion euros. Once again, savers saw no benefit when the trades were working, but bore the systemic risk when they failed. That same year, Lehman Brothers under Richard Fuld dove headfirst into hyper-leveraged mortgage-backed securities. They used short-term borrowing to fund long-term risky positions. When the US housing market began to crack, the whole structure collapsed, resulting in the largest bankruptcy in American history. Shareholders were wiped out, customers lost billions, and the public, many of whom never touched a subprime mortgage, ended up footing the bill through the aftermath of the financial crisis. This isn't just history, it's still happening. In 2011, UBS trader Kweku Abadoli secretly racked up $2.3 billion in losses through unauthorized trades in exchange-traded funds tied to stock indexes. Again, he was using bank capital, which ultimately means the combined deposits of ordinary customers. In 2019, Deutsche Bank sat on a derivatives book with notional exposure in the tens of trillions. While it wasn't a single day scandal, the sheer size of its positions, much of it backed by deposit-funded balance sheet power, meant that a single bad market cycle could have triggered systemic panic. And in 2022, even the crypto world proved it wasn't immune. Sam Bankman-Friedman's FTX took billions in customer deposits and funneled them into Alameda's researchers' leveraged high-risk trades. When those bets unraveled, the collapse was swift. Billions vanished in days, customers were locked out of their accounts, and the market was completely shaken. Same playbook, different decade. Now, these aren't rogue traders acting in isolation. They are symptoms of the system itself. Banks and large financial institutions have a built-in incentive to use your money for their benefit. They call it proprietary trading when they win, liquidity management when they explain it to regulators, and unforeseen market events when they lose. In plain language, it's gambling with your chips. You, the depositor, don't get to see the cards. You don't share in the winnings, and you just get whatever crumbs they decide to sprinkle into your account, while the bulk of the returns are funneled into executive bonuses, shareholder dividends, and the next round of speculative bets. So the real question isn't, should I trade? The question is, who do you want trading with your money? Because whether you realize it or not, someone already is. You can allow a faceless institution with zero personal accountability to call the shots, or you can take control. And when I say take control, I don't mean becoming a screen glued day trader riding an emotional roller coaster. I mean replacing blind trust with a disciplined, rule-based automated system that works in your interest, not theirs. A system where every deployment of capital is self-contained deal. A smart entry when the conditions justify it, a defensive scale in if that entry is tested, and a clean defined exit the moment the opportunity fades. Then it resets, flat liquid, and ready for the next one. That's how you stop being the silent partner in their casino and start running your own table. The banks won't stop. They will keep making bets you'll never hear about until one of them blows up big enough to make headlines. By then, the damage will already be done. Your money is already in the market, whether you like it or not. The only choice that you have is whether the profits land in your pocket or theirs. If you want them in yours, book a call with us today and I'll show you exactly how to take it back, how to build a structure where your capital works for you, not for a bank you'll never meet. Because if someone's going to win with your money, it should be you.